All right, everyone. Hope everyone's doing well today. My name is Jan Lam. I'm the founder of Fortune Homes Team. Super excited and thank you so much for joining this evening's webinar with regards to keep your money, capital investing. So I'm super excited about the topic tonight. And we also have a very special guest speaker that I have the utmost respect for. And now I'm going to go ahead and share his presentation right now. But let me tell you a little bit about the guest speaker. His name is Sir Derek. I got a chance to meet him through a mutual friend that's also very heavily involved in real estate investing. And in the last year or so, I got a chance to know Sir Derek on different capacities from business structure, real estate structure, business acquisitions, very knowledgeable in the finance area, and has done a lot of big deals. Okay. So I'm very excited about having here share a little bit about what we're doing here as an opportunity that I thought was very, very intriguing. I'm super excited about. And as you know, as a person who's been doing real estate for the past 14, 15 years or so, I'm always looking for the deal with the highest reward, but also the lowest risk. Okay, so I think this right here is one of the ones that's going to take the prize with regards to the risk level and the return level. Okay, there's always a cost to a prize, but in this case here, the cost is probably really minimal from a risk perspective. And I'm really excited about having him share this incredible opportunity for everybody, not only from the capital side, but also from the borrowing side as well for those who are actively doing deals. And then the ones who are passively just looking to make their money work for them to earn a higher return that will beat them at inflation and also the interest rates they're earning in their savings account, treasuries, or certificate deposits. Okay, so without further ado, I would like to go ahead and introduce to you our guest speaker for this evening to go through this presentation, Mr. Sir Derek. Sir Derek, can you please unmute your mic and go ahead and start the presentation?
Hey, what's going on, brother? How you doing today?
I'm doing great, sir. Go right ahead.
Good, good. Hello, everyone. How y'all doing today? Hopefully, everyone had a wonderful day, a great week. And first of all, I'd like to thank you, Jan, for the opportunity to, pitch our new bank. So if anyone has any questions, you can submit them in the chat. If I guess we'll just wait to the end, but if I see something that that I think I can just answer right then and there, I surely will. Um, but yeah, so I'm presenting today Dealmakers Bank International. So we are looking to launch a new bank for specifically focused on deal makers. Now, Jan, quick question before I go into it. I'm trying to click to the next one, but I don't seem to have control over it.
Oh, I'm sorry, no problem. Just let me know when the next slide is. I'll go and flip for you, okay?
Okay. Perfect. So you can go to the next slide. So, the purpose of today's webinar, I mean, first and foremost, we're looking for reserve investors. Jan actually came aboard. I pitched this idea to him, what was that last year? Yeah, I think that was last year. And just telling him that what we are looking to do. And he was just like, hey, I have to get you in front of some investors before, if you can do it before you pitch it to other investors, that would be great. So, so the purpose of today's webinar is to find reserve investors, and of course, raise the capital that's needed. Number two is to spread awareness of what DMBI is looking to do. We're just looking to prime the market. So yes, we're looking for investors, but yet we're also looking for future customers. And then, of course, look to get some feedback from the investor market to see, like, hey, about our opportunity, um, and just from investors and deal makers themselves. You can go to the next slide. So, so what to expect from today's webinar? I mean, you get to see our vision and what we're looking to do three 3 years plus. You get to understand what a risk-free opportunity looks like as a reserve investor. And then, of course, at the end, we'll have Q&As for any questions that you have immediately. And then, of course, we'll do follow-up meetings with each and every person that's interested. Okay, next slide. So who am I? My name is Sir Derek Vanderbilt. I've been in finance for 16 years. Um, started off in a company called Primerica, with actually me and my wife. We were best friends at the time. I started off at Howard. We actually met at Howard University. I ended up starting a investment club. And then, out of all of the out of all of the eight members that we had, her and I, she was the only one left. We were the only one left. And yeah, so then we ended up started in finance and actually ended up becoming the youngest regional vice presidents for Primerica at the time. We ended up having two personal offices, 80 plus agents, and then established over $2 billion of life insurance policies. Um, I have I started in 2015 in deal making by just by chance, and then just getting into that, doing loan brokering, and then just eventually that naturally evolving into helping structure deals and everything. And over the past 10 years, I've done almost $1 billion worth of loans of financing, both domestically and internationally, and then also worked on just in the creative deal making space, the M&A advisory space of $3.5 billion and counting, you know. And then I've been always been entrepreneur since I was a kid, starting a business with my mom and dad, and then eventually um me and my mom, and we had our own clothing store. I had a video game store. We would rent out skating rinks to throw parties on the weekend. So, I've always been an entrepreneur. Anything. So then once I decided to like, okay, once I moved to DC, I was like, I want to jump into finance, and just happened to do that when I was 19. All right, next slide. So let's talk about the problem here. So deal makers tend to have a very, very unique problem with the traditional banking system. For one, banks have a lack of creativity. Most banks do not understand or even have the mindset to help deal makers out, to help them negotiate deals or close deals in a creative fashion. A lot of them, as in especially Jan and anyone here can tell you that banks move incredibly slow. And as a deal maker, you need speed. Speed most of the time, outside of of course, rapport building will be the thing that actually gets you the deal. And then, of course, the reason why you have those problems with creativity and speed is because of a rigid framework. So so for most banks, the regulatory framework there doesn't encourage banks to, be creative, to, to go into second position for a creative deal, or behind the seller, to allow for, you know, different, just to allow for different models when it comes down to buying properties and buying businesses. All right, next slide. So, now how does it impact deal makers? Now, I have an example here of a company from last year. So I'm sorry, ABD Oil Services. They had an acquisition prospect where they was looking to buy a smaller company that was going to actually increase their revenue by 60%. Now, the thing about this, there was other bidders, right? But of course, they built a rapport with the client, but they needed $2 million as for EMD. Now they were underwriting the deal because, as we all know, hey, you might as well start underwriting the deal before you even get on the contract to see if if it's even a deal worth wasting your time on, spending your time on. So my client ended up going to their bank that they were getting the loan from, just to let them know, like, hey, we need $2 million, but we want to structure it in a way to where we just need to show them that we have $2 million, and so we can get on the contract for the 45 to 60 days it's going to take for you to fully underwrite the deal and everything. Well, the bank said no. The bank said, hey, because of, we're underwriting, if we was to issue you credit, it would actually, kind of throw off the underwriting process in general. But then also they're not really, at the same time, they're not really used to this as well. I remember their broker, I'm sorry, their loan officer was actually pretty open to it because he was familiar with EMD. Um, financing, but again, rigid system. So what ended up happening, unfortunately, yeah, I can go to the next one. They end up losing the deal to a competitor. So because the other competitor, they had the capital to put down as EMD. And as we know, sometimes that doesn't matter, meaning even though they get on the contract, it might fall through. But unfortunately for them, it didn't. It was a bigger competitor that came in and took the deal from them. So, you know, looking at that, I mean, that's what really gave me the idea to, build a bank that's, for deal makers and created by deal makers. Next slide. So I'd like to introduce you to Deal Makers Bank International. So what is DMBI? I mean, our vision and mission, first of all, is to ensure that deal makers have the highest chance of success by providing them what I believe is the most crucial capital needed in deal making, which is launchpad capital. Our mission for the next 5 years is to establish 5,000 core deal makers that we can bring into our ecosystem that can do at least $3 million worth of deals per year. Now, some of you might ask, what is Launchpad Capital? Now, for us, our product, the Launchpad Capital, the Launchpad line of credit, this is basically a line of credit that deal makers can use to do one of these three or all three of these transactions. So you have transactional financing. That's basically your table funding, mostly used for double closes, but also in business acquisitions, you can use that for double closes. Outside of real estate, you can do that for double closes for real estate. There's a lot of creative ways you can actually use double closes for, like if you wanted to get more funding for something, you can actually use double closes for that as well. A big one, is something that my wife and I have been personally lending into for the last 2 years is escrow financing. So this is where basically we're financing someone's escrow, so that they can go on the contract and go and perform their due diligence and everything. That's been a very lucrative business of ours, and we believe that that's going to be a very lucrative part of the bank as well. And a lot of people are very excited about that. And then of course, thirdly, gap funding. Gap funding, of course, it closes the gap that's needed to secure that senior debt. Um, Most deals, if we're being honest here, I mean, we've all had a deal where it was a great deal, it was good margins, it just made sense overall. The numbers were there and everything, but you couldn't do it because maybe you didn't have the gap funding. Maybe at the end, I just recently had a deal that fell through because the lender at the last minute, they told us originally we need to put $2 million in, and then at the last minute, they asked the client to bring $3 million to the table. So there's a huge opportunity for all three of these. All right, next slide. So, I know I've given some use cases, but I want to kind of go through a couple use cases that's recently happened this year. So when it comes down to transactional funding, I had a client that was looking for that's here in DC that was looking for um 300,000 because they ended up getting a property under contract for 300,000. They ended up having a buyer that was willing to pay 380. So of course they needed, $300,000 in order to close the deal and everything. Escrow funding. I had a client earlier this year that was looking to buy a $15 million portfolio, and he ended up negotiating the 15% earnest money deposit, so that they can underwrite it, and we was able to do some other creative stuff with that. But he needed $2.25 million for 45 days. We end up charging him 20%, on that. And luckily, hey, the money that I put together for that, there was no risk there. And then of course you have gap funding. The same deal maker actually ended up needing a little bit more money, because it was supposed to be 80%, but they ended up coming in at 7% loan to value. So they needed about 10% in gap funding, which was about 1.2, I'm sorry, $1.5 million for 12 to 24 months. So how do we source deals? So I have a huge network of I would say probably about 500 deal makers, lawyers, CPAs, brokers, and our secret weapon is that we're gonna combine all those into our deal makers banking club. You know, this right here is a paid invite only community that really just focuses on like teaching people how to put together deals, teach people how to raise fund, how to raise capital, and then just also do deals among each other. So, we've had a lot of inquiries about that. We're actually going to do our first launch event here in DC in the first weekend of June. So, I think, oh, sorry. So, I think with that, given that I work with a lot of groups as well, and I mean, even when you look at Jan's group, there's going to be a huge source of deal flow for us. Okay, now you can go to the next one. So the numbers. So now we're projecting, and of course, these are high level numbers, but given the express for interest that we've gotten from groups as well as some, like individuals when we did a small marketing campaign, we think that, our first year, the first 3 years, which is the plan period, we think we'll get all the way up to $40 million. And of course, being that we're really only trying to focus on groups, and we're only trying to focus on our deal makers that's going to be in our deal makers club. We think that our expenses is going to be low because at the end of the day, technology is making things a whole lot easier and cheaper to do. So we already have been working with a company to develop out a platform that could really help us. Like instead of something that used to take 30, 40 people to do, I mean, it only needs like 5, 10 max, right? And then of course, as we grow the revenue, we're going to grow the assets of the bank as well. And as you see in the first year, we're looking at 30 million. This does include the capital that we are raising. But the second year, about 100 million or close to 100 million. Then in year three, about $300 million. So what traction do we have now? Now we did a small campaign, a small word of mouth campaign, with groups, and we end up getting a little under 45,000, so it's a little over 44,000 pre-signups. So people that are excited about what Dealmakers Bank is looking to do. Of course, in in the past month, I would say about in the past month to 45 days, I've been, getting a lot of the groups that we work with to actually look to pre-sign up for our line of credit and everything. With that, we've actually crossed, I'm sorry, yesterday we ended up crossing $100 million in pre-signups. And these groups will, with groups, we'll have a minimum of like a $5 million line of credit that we'll issue them, everything. Of course, you have the Deal Makers Banking Club, which we've received about 200 inquiries for that. And then we have regulatory traction. So I've been working closely with the regulators in the jurisdiction that we're looking at. And they love our business plan. They love the idea. So, and they're asking us to go ahead and apply. So the team, you have myself, my name is Sir Derek Fanfive, you have my wife, Lady L, you have Curtis who introduced me to Jan, and of course you have the great Jan Land himself. So I'm sorry, go back for a second. Yeah, so our team is like have very diverse backgrounds and everything. And this isn't everyone, but this right here is like it's like the core people. You know, my wife and I, we have financial service experience, and my wife also has marketing experience. Curtis and I have been working for together for years, and we've done a lot of deal making. Um, he's referred me a lot of business. We've worked on a lot of projects and everything. We funded a lot of projects, and then of course with Jan over the last year, we really become super tight, um, and we've worked on a couple of deals as well. Okay, so what you all are here for is the opportunity. So, as a reserve investor, well, no, I guess let me back it up real quick. So, when it comes down to banking, you have different tiers of capital. You have tier one, tier two, and then everything else. So when it comes down to how banks actually um, are regulated, they're mainly regulated off, yes, their balance sheet and everything, but in their balance sheet, you have their tier one capital. Their tier one capital is mainly like, hey, how much liquid funds do you actually have, right? Because that amount of liquid funds you have controls or I guess regulates how much of loans you can actually issue. So what we're looking to do, and then is so what we're looking to do is actually raise our tier one capital, but we want to do it in a very unique way. I ended up working on a deal in Switzerland about 5, almost 6 years ago. And it's very interesting because the broker that I met with, he was like, hey, if you know anyone or if you and your wife have $3 million, you guys can actually invest without putting out any of your funds. And you can earn 8 to 10%. So, I'm thinking to myself, like how, anything. And he introduced me to reserve investing. So this one company was raising funds just so that raising reserve funds so that they can qualify for more funding for the specific acquisition. And then unfortunately I can't disclose the bank that facilitated this, but we ended up becoming a client of that bank. And then later on, that bank ended up having a very similar program. Now they wasn't paying as much, of course, because they're a bank in, in Switzerland. So it's like so they have a lot of money. But what I end up finding out is that banks do this a lot, especially Swiss banks. So I always thought that was interesting. And I was like, if I'm going to raise capital, I'm going to look to structure an opportunity like that. So what the opportunity here is that we're looking to raise tier one capital in reserve funds or paper funds, right? To where we can show the regulators like, hey, we have X amount of investors that have X amount of funds, and we raised, X amount of funds from them. And so that right there will cover our tier one capital. Now, what we're looking to do is we're looking to allow for the reserve investors to just keep their cash on hand with them. So and how it would need to be structured is it would just need to be structured where you guys will create either reserve account. And typically that's just a sub account in your bank account. That is so in your bank account back office. So, you would just need to keep the funds liquid and unencumbered in your savings account. And it could be a money market account, it could be checkings or savings, and in some cases it can be U.S. Treasuries, but that would need of just about 2 or 3 pieces of paper that need to be signed in a way. Okay, you can go to the next one. So, well, I'm sorry, I just explained the process. So yeah, explain the process. Reserve investors simply hold liquid cash in sub accounts of their own creation, checking, savings, money market, and in some cases, the U.S. Treasuries. You guys would then provide us with the a view only access to verify funds and make sure that they remain unencumbered and liquid for the term that for the the life of the term and everything. So that could be we have two options, a 3 year option and a 5 year option. And then of course it needs to be unencumbered and it needs to be liquid because regulators when they do their bank examinations, they're going to in some cases they're going to ask us to just show them like hey with our packet we send it over to them, but then sometimes they will ask for a swift message, um where they'll actually ask for so they'll send a message to the bank to make sure that the liquid funds are there. So that's why it's very important for reserve investors to keep their cash liquid and to keep it unencumbered. And I know some people, most people understand what the SWIFT network is, but the SWIFT network is the Society for Worldwide Interbank Financing. So it's basically a message system that banks use to communicate with each other. And so another reason why we need the funds to stay unencumbered and for it to stay liquid is because as we go out there and as we raise funds from either the interbank market or the Fed themselves to do some of our financing, you some of those banks will actually send Swift messages as part of their underwriting. So that's why it's very, very important for us. So we're expecting that about a one to three messages per year, because we're looking to get underwritten early on, and then of course they'll probably just check to make sure that our liquidity's there probably 6 months or 9 months later and everything. Okay, you can go to the next one. Okay, now I know a lot of people are probably asking, well, if you don't have our funds, how are you going to lend money? Well, it's very, very simple. It's very simple. So you have this thing what's called the capital adequacy ratio. So that's basically when the regulators, whether you're getting underwritten by the Fed or by another bank or even by your bank examiner, they're going to look at your car. And with that, let's take for instance, I know many of you all have understand fractional reserve banking, whether maybe not in depth, but maybe at a high level, where like hey, for every dollar they have, they can lend out 10 or lend out 9, 10, things like that. Well, the reason why we need you to keep those funds unencumbered is because we're going to again get that get our bank underwritten to then facilitate a larger line of credit so that we can then take that line of credit and then do our all our operations from there, everything. The great thing about what we're looking to establish is that this will be considered an off balance sheet asset. So lines of credits do not go on the balance sheet as assets or liabilities until they're used. So, you can establish, what you can establish have 100 times, your car, but that only really the car really only kicks in when it comes down to capital you've actually issued, loans you've actually issued, transactions you've actually done, and everything. Um, the great thing about also what we're looking to do out of our three products that we're looking to do, which is transactional, escrow, and gap funding, two of those really don't have any counterparty risk because when it comes down to transactional financing, the capital really never leaves the bank. It's just placed in escrow at our own bank, um, where we're just saying that hey, we have this, and that funds or do not leave out of our ecosystem until the other funds are in escrow. So the third party buyers funds are in escrow and is issued ready to go. And then we can then release the funds then, or realistically, if we're being honest, in some cases you could just, since banks take a couple days to since moving money takes a couple days, then you could really just issue issue the funds, issue the promissory note, and then just once you get the funds into your bank, just instantly send it to the other bank. You know, when it comes down to escrow financing, um, there's a little bit of counterparty risk there. It all depends on how you structure your contracts. So, my wife and I, when we do EMD deals, we structure in a way to where our funds are um, never really go hard, or if it does go hard, it's under certain conditions to where it will be paid out. So, I've a lot of experience in this particular field, as well as we have other players as well that I'm sorry, other partners as well that specialize in that. And the only thing that's really where there's like some risk there is the gap funding, you know. So and then on top of that, how we're also going to lend money is also we're going to retain earnings. So we're gonna get commissions off everything, and then we're going to retain those earnings and then start lending off that. All right, next slide. So what are we looking to raise? We're looking to raise $10 million. Um, because we believe that $10 million is a good starting point, is a good floor for us. And on top of that, it will be, it will show the interest from the, from the market to the regulators, everything. So, I think that $10 million is a good baseline. Although, we've been getting a lot of interest, so we might actually bump that up and maybe oversubscribe everything. All right, so the capital structure. So how the capital is going to be structured is as $1 per share. We have a minimum 500,000 shares that has to be bought. But if me and Jan have talked about this, for we've talked about this a couple times, is that we're open to going as low as $100,000 because we're not sure how how much capital you guys have, but at the same time just making it accessible to as many people as possible. So we're open to go as far down as $100,000. Um, when it comes down to how you guys will receive your interest, well, we're looking at it from simple interest, 10% on your funds. It'd be paid out every year. Now, the first year we're looking to have that schedule at paid out at 18 months and then 24 months and then of course 36 months. Now we do have an option for if you want to let it compound, then of course we can, you can let it compound as well. Um, and again, like I told you, the minimum commitment is a 3-year term. So now what we're looking for soft commitments to be put in by the 28th of May to receive that 10%. Anything after, let's say, June 10th, we're looking to pay 8% compounded interest for that 3 year. So, so we're really looking for investors that, that are very interested, that are like fast movers and everything. But, so that's why we're giving 3 weeks, so that we can, meet with you guys afterwards and, and talk and get all your questions answered. All right. So let's talk about risk factors here. Now, there are some risk factors here. There are no cash risk factors here, but there are some risk factors here. Now, the first and foremost is the licensing risk. There is a chance that we do not get our license. Like first and foremost, I think if anything, that's the first risk. So for some people who have to move cash around and things like that, there is that risk that, you know, we apply for the license and for some reason they're just like, no. So you have that. You have the regulatory risk there. So things might shift. As we know here in America, the regulatory um the Trump administration is changing things all the time, everything. Now, I don't think I don't think banking is going to, just get changed overnight and everything, but you never know. I mean, we've had economic crashes before that completely changed the regulatory framework and everything. But still, we have to disclose that. When it comes down to liquidity commitment risk, now that's on you guys decide. Something might come up, something might come up and you guys need your funds. And the fact that you have your, you'll still have your funds actually makes it more risky to us. So there's that risk that, let's say, something comes up and you have to pull some cash and it drops down, your our liquidity or the liquidity that you're holding and everything. But there's a risk that, you won't earn, there might be some penalties there. Of course, we'll disclose that in more of personal setting, but I mean, that there is that commitment, there is that liquidity commitment risk there. There's return risk as well. 8 to 10%, is promised, but just say if the world, blows up, or for some reason, we're just not able to, you know, um, have, we're not able to truly perform like we're projecting that we're going to perform. I mean, you might have delayed payments or missed payments, or the bank might fail and things like that. So you do have that risk to where you don't have that return. But I will say this: banks have a 2% failure rate. So most banks that start last until at the minimum 12 years. Right. So, there's many different exit strategies that we have, from issuing bonds to using our primary line of credit to basically to pay off investors or do stock buybacks. There's a myriad of things, even going public if we have to, everything. But I don't think 8 to 10% is going to break the bank, everything. But that is a risk that I must disclose. Bank structure risk, like I said, if the bank fails to meet, overall capitalization goals, I mean, we could have, a penalty. So it could be like again, that goes back to the regulatory framework where, you know, things might get reconstruction, might change, the regulatory landfill might change, and we might have to hold more liquidity. So, that there's that structural risk there. Um, and then when it comes down to custodial risk, I mean, for you guys, a lot of times, some of your banks may not have the capability to have a view only, um, to give view only access and everything. So you might have to use, some other bank, or your bank might actually change, because I've seen that a lot, to where banks kind of change new core banking service providers, and they just don't have it and everything, right? Now our work away now how we've worked around that is that we don't mind just, you guys sending us bank statements and stuff like that. But again, we would have to eventually send a Swift message, and just to make sure that the funds are there, everything. All right. All right. So conclusions and the call to action. So when we're looking for liquid investors that are looking for conservative opportunities with high returns. We're looking for investors that have liquidity at the moment, or can get liquidity, by the time that we have that we get our license issued. You know, these are, and that are interested in earning, market returns, or even in some cases above market returns, but who also can commit to a 3 to 5 year, that can commit to 3 to 5 years. you know. So they would just need to simply have their funds unencumbered and they're liquid. So I know there's gonna be a lot, there's gonna be a lot of opportunities, especially with the markets being down. But again, we're looking for conservative investors who want something guaranteed. The next steps would be to get access to our data room and set up an investor call with, uh, Jan and myself. And then fill out, of course, our investor form to kind of to move things forward. All right. And yeah, and next slide, and that's it. So QA, if there's any questions, I'm totally open. I'm totally open to them. We can't hear you, or at least I can't hear you.
Oh, you can.
Okay, I can hear you now. No, no, no. Sorry, I can't hear you now. You just muted it.
Okay, hopefully you can hear me now. But yes, if you guys have any questions, please feel free to go ahead and either type in the chat or go ahead and unmute your mic, and we'll take questions one at a time for those who raised their question on Zoom. Are there any questions right now for Sir Derek?
Hey, Sir Derek. My name is Rakesh. Hey, Jan. Nice to hear from you again. It's been a while since you
Oh,
gave us the
Rakesh.
briefing.
Hey.
Yeah, with Hamel. Remember?
Yeah, yeah, I remember. Hey, what's up, bro?
Yeah, yeah. So, hey, thanks. Great briefing here. A couple of quick questions. One, you had mentioned about the risk factor, and in that one specifically, you had talked about the bank risk. But then in earlier discussion, I also heard, well, we can't really disclose the information about the bank. Am I understanding that this is the same bank that we're dealing with, or is there two different things? Because
Oh,
it's
no,
one of
no.
those where we're describing the risk, but then we're not quite, I'm not sure if I'm understanding that.
Oh, okay, okay. My apologies. My apologies. No, no, no. So what I was saying is that the Swiss bank that that we end up learning this from, basically, I was I can't really disclose what that bank is and everything because I mean I did sign NDAs for it. So no, it was a bank that where I got the concept from that I was saying that I can't disclose what that bank is. I will say it starts with a P and it's a pretty big bank in Switzerland. So you know, that's probably
Okay.
probably as far as I can go on that one.
No, no worries. No, thank you for that clarification. Yeah, I just wanted to confirm. And then I think the interest you had mentioned, so the amount of money that, let's just say, I think the minimum investment you said you could do up to 100,000 starting, but go up to $500,000 as an investment. And then the rate of return is going to be, let's say, 8% to 10%. Now, is that essentially regardless of the amount that has been kind of, confirmed amount? Or is that even if you put 100,000, that's still the same rate of return. And I'm assuming that's on per annual basis. Is that correct, or is that for the duration of the investment? So if it's like 36 months, or is that
Oh,
10% for
right.
36 months?
No, 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 no. So it's per annum. So it's per annum, and it's on any amount above any amount that above that $100,000 threshold. I don't really like to the tier. So whenever I structure deals, I don't really like to tier things out. I have before, but now for this right here, it's just pretty straightforward. We're looking for, investors that have high, that have liquidity and we're willing to pay for it. I think 8 to 10% is a good is a good number to attract people, especially if it's like you get to keep your funds. You get to keep your funds at your bank and everything. So, ultimately you're really not investing, even though you'll get issued shares and, I guess technically the funds would be ours, but you're the custodial because the custodian over the funds. So yes,
Okay.
a long
No,
way to say that that's per annum
per
and
annum. Okay. Yep.
it's
And
it's
then
it's on any amount. It's on any amount that you invest above the any money that you invest. My apologies.
right. So just to, and I apologize, I had joined a little bit late, coming
Sure.
in, so I think I missed the first few slides, but I think I got the gist of the actual presentation towards the end. So if I'm understanding correctly, essentially we're basically confirming the amount to say here's how much we're willing to kind of invest, but invest meaning that here's what we're going to basically have this amount allocated, not uh not to be used for anything else.
Yeah.
But I did hear that would put it in high yield savings account. Now, as far as if that amount, let's say, is invested in ETFs or any sort of it, does that count, or does it have to be strictly just like liquid where it says, okay, high yield savings account? Because even an investment ETF, if money is, let's say, necessary or needed, it could
Yeah.
be sold, and the cash could be, moved into an account. So I just wanted to kind of
Right.
understand
Right.
that nuance.
Right. No, no, no. That is a perfect question. And I'll actually go a little bit more in detail of this. So the so you can. So I'll say this. I'll say this. Yes, you can do that, but what would have to happen is, right? And that's why I'm just like, I mean, it's some paperwork that you have to do and some things you got to move around and stuff like that, and that would cost you money. So typically, what you could do is, or what you would have to do in regards if you wanted to hold in ETFs or any type of equities, is that the cash will need to be, the bank will need to invest in that. So meaning that those accounts that you have would need to be the bank's account. So meaning that you, whether you, again, you establish those and you put that under the bank and everything, but how that would normally look is like, oh, you raise the cash, you have the cash, and then the bank ended up investing its money into these particular equities and things like that. So you no longer have ownership of that. So that's why we kind of stayed away from that, because you can do that, but it's a lot of moving parts to that and everything, which raising it from a pure liquidity standpoint. So I mean you just, it's just liquid cash sitting in your bank. That's just much easier, you know. Um, but yeah, so that's why I say the whole, even the whole US Treasury things is a little bit, is, it's one of those things where it's like, well, you could commit the US Treasuries as like, oh, your way of funding it, because when the when you're looking at the risk weighted ratios um of the banks, so the banks risk weighted assets, it's basically, it's, if it's treasuries, it's basically zero. So it's kind of like cash and everything. But again, you have to kind of get approval from the regulators and stuff like that, and it's just a lot that will go into that. And
Oh,
I guess I'll just disclose this part to everyone. So currently, my wife and I, we actually do own a bank currently. But that bank, how we bought the bank, and it's in Puerto Rico. It's a bunch of stuff that went down with that one. But basically it has a lot of restrictions on it. So that's why, we ended up just going, we're just gonna go after another bank and everything. Um, the one reason why I didn't disclose it is because, some people ask like, well, why don't you just change the business plan around for that bank? It's simply because we can't. We have to wait another 20, I think we're like 20, no, we're actually like probably like 19 months, to where we could then submit a change of business plan and things like that. But then, there's other aspects to that. We're not the biggest fan of the regulators down in Puerto Rico. They end up losing their accreditation with the Fed and everything. So it's just a lot that goes to it. So the other jurisdiction that we're looking at gives us the same opportunity, same framework, but it actually is a lot better if we just either start from scratch.
I was going to mention also, if you have your liquid cash into, let's say, a savings account or a money market, whatever your bank is paying you there, you keep it as well. So if you're earning 4% in your money market, you keep that, but then you top that with the returns over here at Dealmakers Bank International, whether it's 8 or 10%. So you kind of, it's a chance for you to double dip on both sides.
Yeah,
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 thanks for clarifying that. Yeah, that was actually one of the questions I was going to have was, is that considered okay for, let's say, if you have that money into that account and then you're making that percentage, and then whatever percentage that's being made on top of that. So no,
yep,
that's a good clarification.
Awesome.
yep, yeah. That's exactly why we structure it like this, because most people right now, because the people are pulling back from the markets, because the markets are crazy. I mean, even before the Trump administration got in and started messing around, a lot of people kind of pulling back anyway. So that's why it's like, okay, well, hey, this is a safe, nothing safer than cash. Maybe gold right now, but you have where it's like, oh, well, you can earn a pretty good interest rate now and everything, and then you can earn our 8 to 10% on top of that, and it wouldn't be like, oh, if you're earning 4%, we pay 10%, and we're only going to pay 6% and everything. So, it's just 10% plus maybe let's say 4%, so you earn 14%. So that's why I was saying earlier in the presentation, you can earn at market or even above market returns.
Awesome.
And I'm sorry, I'll have one more question
Go
to
ahead.
ask. Uh, so the one question was, so is there ever a point where, let's say, the money gets called? I don't know how to frame it, but like let's say, because you're essentially, I think it seems like you're using this money as a collateral in some sense, and I'm just wondering, is there ever a chance where, that money is like, hey, you gotta give us that money to kind of prove that you have the liquid cash. I
Yeah.
understand that
Yes.
there's banking, and there's also that one little piece of, hey, just show us the paper value, and sure, I understand that, but would there be ever in that time frame that yes, we need that, and send us a check for, let's say, $200,000, whatever it is
Yeah,
you needed
no.
to.
No, no, no. See that's I mean that's the great thing. So I'll say this. And Jan knows I am way better at answering questions and off the rip than I am presenting. So but no. There how we have it structured, you will always have you will have your cash. So when underwriting, right? So that's where you go back to CAR, right? And capital adequacy ratio, you having that, so you showing that, hey, in my bank's coffers and things like that, whether our reserve accounts, our direct accounts that we're holding with the Fed, or any account like that, we have X amount of capital, right? So that when underwriting happens, they'll look at our reserve capital, they'll look at they'll probably look at also our operating capital. So they look at our capital as like our whole capital stack. That's all our liquid cash. Then they'll take a look at our assets. Where like what do we have? It's either unencumbered or like what's the equity that we have in our, or like in our portfolio. And then that's how they make their decision when it comes down to other banks. So when we go to the interbank markets to ask for, let's say, $100 million, or when we go to the Fed and ask them for a primary line of credit, they're going to look at that as well. So, but the main thing that 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 if our bank have zero assets and they only had like zero like outside of cash, so zero assets outside of, let's say, the $10 million or whatever amount of capital that we end up raising for the reserve capital, they're going to look at that and they're going to multiply that by a factor of 10. Right, a factor of 10 and everything. So, and then, if we decide to get a designation, which I don't think we're going to get an MDI designation and everything, because we're going to have like tax benefits as well. Like we're going to pursue a favorable corporate tax rate. So I don't think we really need to get the MDI certification because that does put a little bit of restrictions on there, but it's really not even 10%. I mean, it's really your liquid cash is really 8%. So if we had $10 million, we could borrow $120 million and stuff like that. But again, when it comes back down to it, and I'm sorry for taking to from having such a long response, but when it comes down to it, also is that when we're issuing the line of credit, and two of our products have basically no counterparty risk. So when you're actually looking at like, okay, what's going to be purely underwritten, like from like where we have to look at our car ratio, our risk ratio, sorry, weighted asset ratios and things like that. It's really only going to be on the gap funding. It's really going to be on the gap funding. That's going to be a smaller segment of our business that will open up over the 3 year plan period. So, if we have $100 million, at the beginning, it's probably only going to be 10%. Then it'll grow to 20, 25%, 30, and it's probably going to cap off realistically at about 50, 60%, of our true car.
Awesome. Okay, good stuff, guys. I think we have time for maybe one more question. Does anyone else have a question by chance?
I'm here all day.
Request? I'm sorry, request. Excuse me. Are you sure you have any more questions?
I think I'm good. Thank you so much. I appreciate yeah, I appreciate it.
No
This is very
problem.
informative.
Good to hear from you again. Anyone else, guys?
Y- Yeah, so Derek, this is Victor Chopra. I have a question for you on the payout that you're talking about, 8 to 10%
Mm-hmm.
payout annually. How do you guys project that paying out based on the pipeline that you have on on some of the product line that you're going to be offering this to the investor base? How do you go about establishing those projections to make sure that those commitments are met at the end of the year? This is like more like a people pledging, set aside money for you guys to use as a car ratios for the bank,
Mm-hmm. Mm-hmm.
right? uh, and
Yeah.
and if
Mm-hmm.
you can elaborate a little bit more. Okay, hey, you say you are in the process of raising, how much you have raised, how much, what addition, what's the minimum cap you have to have in order for to get your line of credit from the Fed or interbank market?
Okay. Okay. So I think that sounded like three questions in one. So
Yeah.
let me answer the first one. So when it comes down to it, we already have, so we just crossed $100 million in free signups from groups. So there's people like Jan. I have a couple other groups like that, right? Where they're looking to come to us and get established a minimum $5 million line of credit, right? So we have a couple groups that's already expressed interest there. I have a conditional letter of intent with each of them, and when you go into the data room, you'll be able to see that. Now, some of the stuff's going to be blocked out because we don't want people contacting them, and they don't want people contacting them, everything. But you'll be able to see a list of professional groups that have basically pre-signed up, express interest like, hey, Sir Derek, we're very much interested in this. I have a real estate group, I have a business buying group, I have a search funder, group and everything that's very in that I'm interested in providing capital, you know, to them or providing capital through you to them.
Hmm.
Everything. We're charging, so we're charging at 1% fee. Of course, you divide it over 12 months and everything, but we're charging a 1% fee for that line of credit, right? So if it's $5 million, you're looking at 1% of that is $50,000 divided by 12, and that's 4,000, about $4,200 a month is what they're going to be paying just to have the line of credit open with us. And then of course, then whatever they use, we have fees that, of course, like rates that we charge for that. So if we're looking to, and we're actually looking to establish before we even open, we're actually looking to establish $250,000. I'm sorry, $250 million of like free sign of business through groups, right? So that should, especially even if we have a conversion rate, like a true conversion rate of, let's say, 50%, on 250, that's 125. So that'd be $1.25 million that we'll generate per year. And then if you have like 10 million, I mean, on $10 million, that's $1 million. So that should cover that, and then leave us with $250,000 of like operating, cash to operate with. So that answers your first question. Could you please remind me of the second one? Because I want to
No,
make.
I think the second, with the first one, you were able to, by signing up groups like Yarn, you
Uh-huh.
already identify the people who are reaching out to you for these line of credit, which they can offer to uh, their peers who they work with on daily basis, with either the table funding, escrow funding, those kind of vehicle, the gap funding. you charge a set amount of fee every year, every month, annualized rate, which is 1% on that line of credit
Mm-hmm.
amount that you issue,
Mm-hmm.
uh, plus the additional origination or interest charge once they draw down on that line of credit. So
Yeah.
that's how you monetize on the reserve funds, 10x what you
Yeah.
get against from the bank or the Fed. That's what my understanding is, right?
Yes. Yes.
And that's how you suffice your uh, annual commitment to the investors who looking to come on board with basically aside the minimum amount of, I know you say 100,000 for now, but it will go away, and the minimum requirement would be about half $1 million.
Yes. Yes.
Okay, got it.
Yeah. But well, I'm sorry, but I feel like there was three questions you had. I did I answer the third one?
Yeah, yeah, you did. Huh.
Okay. Okay. Perfect. Perfect. I just want to make sure.
Awesome. Good stuff. Great question, Victor. Anyone else have a question? Didn't get time for maybe one more. Nobody else? So that means that everyone knows exactly how this works. And if you guys know exactly how this works, I don't know why you would not be interested in filling out the form that was sent in the chat box, right? So I do apologize about the initial link I sent. Sarah caught it. I forgot to put the .com there. So I went ahead and sent a new link there that you guys can click. I'll also send a follow-up email with a recording of this presentation that you guys can use as reference. And if you happen to know anyone else who might be in a situation where they're interested in being conservative with their investment, they don't want to play around the stock market or other things, and just want to leave their money in the account and earn 10% or 8%, then please do share this presentation with them, and we can definitely work something out to any referrals you may send to us as well down the road. So with that, Sir Derek, are there any final thoughts that you want to share before we finish the meeting today?
I think, you know, um, you and I have talked about, a couple different things. Um, this recording will 9 out of 10 be in the data room. Just want everyone to know. Um, we are looking for, commitments pretty early on. Now, again, you can commit to being a reserve investor, um, now early, but we won't need the funds. We won't need like you to have the hard funds, the hard liquid cash until, the license issued. I just want to make that clear and everything. Um, so, even if I know some people might think like, oh, I have to move some stuff around like immediately before the due date and stuff like that. No, no, no. No, you don't need it um that quickly, although we would like for the investors that do have that can kind of lock in and everything. So the ones that do have it, you can lock in to where, because again, I do have, we're doing an early presentation to, to you guys, because I know Jan. And then we have like other groups. So, we're looking to take 10, but that is looking like they'll fill up pretty quickly because we do have a soft commitment of 4 million from from another partner, another person I know as well. Um, they haven't made their commitment. I also gave them the same May 28th date as well. So I would just say, if anyone have any questions or you want to go into deeper detail, like I said, I'm better at answering questions than I am presenting because I haven't presented in a long time. So I thank each and every one of y'all for putting up with me on that. So yeah, so if you have any questions, I'll be here. You can, set up a meeting either through Yan or through my Calendly link, and then you can get access to it. And then, hey, I spent 3 hours just answering this one guy's questions before, so I don't mind. I love this is a passion of mine. This is something that I do all the time, and I just love. So
So Derek, yeah, one last question was the three-part question was, what's the first round raise? What's the minimum raise you have to qualify for the car to access to the interbank line of credit or Fed?
oh yes, yes. See that was the other one. So
Yeah.
okay. So now there is no minimum. So I'll say this: there is no minimum car rate in regards to for like underwriting. I'm sorry, for like a primary line of credit or through another line of credit through an interbank, right? The minimum capital that we need to have for the license. So I think it's probably a little bit of a better way to a better structure that question is our minimum capital that we need to raise at current is $5 million. So that's why we're raising 10 so that we could be like, hey, we have we overly have the funds to open this bank and and get started and stuff like that because we have clients. So kind of when we're putting this together for the regulators, we can show them that hey, we have you know uh 44,000 inquiries for this particular product. So the market's there. We have you know X amount like a $250 million sign like in pre-signups from like the groups that we're working with that have access to more people and stuff like that. So that's a market um disclosure there, right? That's showing that there's interest in the market there. We have $10 million or $20 million, whatever we whatever we end up at, we have the oversubscription when it comes down to the capital, over the minimum and everything. So it's like, and we already have the capital. So when you issue us a license, we can open in 30 days, and everything and start making loans. So that's if that should answer your question, I hope.
So, beside from the capital reserve that you would require from the investors, what other kind of proof that or documents you would need from the investor to make sure to provide it to the regulator that this set aside funds are going to be there for next 3 years? Is it those are the agreements that you would provide for us to review and sign it? Uh,
I'm sorry. Could you go back like 10,
so the capital reserve that you would use as a part of the capital structure, right? That you would
mm-hmm.
provide to the regulators to access to this line of credit. What other documentation you would need from the investor beside from just a shown account that they have $300,000-400,000? They has to have some other agreements in place, right? That the money that they're pledging that they will not use it for next 3 years.
Oh yeah, yeah, yeah. No, okay, I get what you're saying. I get what you're saying. So we are going to send out. So when we send out see, it's not going to be a straightforward PPM, but it's not going to be as a thick PPM. But when we send out the PPM and the subscription agreement, it'll have all that. It'll have all that in it. It'll say that hey, you're buying shares at $1, per share. It has a repurchase agreement into it as well that's saying that, hey, we'll buy, once we pay you out the equivalent of XYZ per share and everything, then the shares that get returned to us after the 3 year mark and stuff like that. We'll also have it to where, we can pay you off earlier. So if we want to pay you off earlier, then that way that protects you as well to make sure that you guys would, even if like let's say we blew up next year, and everything. We're like, okay, hey, now we was able to do $100 million in revenue and stuff like that, right? Well, in normal cases, then you know, you guys will only make the 10% for the year. But no, no, no. How we'll have it established is that you'll make sure that you guys get the 3 year minimum. So you'll get the funds for you'll get the interest rate for the 3 years and everything. So, it incentivizes us to, I'm sorry, it incentivizes if we do pay you off. I'm sorry, if we do have a big explosion and stuff like that, then we can pay you guys off early. And on top of that, you guys can make sure that you get your funds, all your returns and everything. So, um, And then so you'll see all that. You'll see all that in the PPM and the
Got
subscription.
it. Okay, thank you.
Yeah. No, no problem, no problem.
Awesome. All right, guys. Well, thank you so much for hanging in there. I really appreciate your time. Please look out for an email sometime tomorrow morning with this recording once it's fully processed through Zoom, and also a copy of the slides for your reference. And look forward to hopefully working with you. So thank you so much. Have a great night, Sir Derek. Thank you so much for your time.
No, thank you, and thank you everybody.
Thank you.